morning, everybody. This is Fred Meissner, and welcome to the Fred Report conference call for July 28th, 2011. Certainly, time is flying by, as they say. It's almost the end of July. Didn't think the year was going to go so fast. We'll get right into what's going on, and I guess the first thing to say is this week the market has been a little bit of a surprise to us. We were really set up at the start of this week to really go through that 135 area, 136 area on the spider and head up. Instead, obviously, we've turned around and done rather badly. A couple things that may mean. First of all, that does make the indicators look worse, and the reason for that basically is indicators like the McClellan oscillator, for example, was very oversold, and this rally, if this were going to be a really good rally, the rally off of the 130 area before, the 129.50 to 130 area, should have taken us to new highs. No, the indicator should have gotten overbought again. Stochastic should have gotten overbought. Instead, what's happened is these indicators have actually rolled over again and come down. The McClellan oscillator, for example, has made a new low. Now, the good news on the McClellan is it's in the minus 229, minus 230 area where you normally get a really good bounce. And that could be starting today, and we could see a bounce back up towards 133, 134 if we're lucky. The problem with that is if the indicator fails to bounce and turns around and gets really oversold again, you may see a situation where we just go and make new lows on the market and new lows on those indicators. I mean, we just don't know the answer to that question at this time, but we would have liked to have seen the indicators get overbought, and they did not. So a little more caution. We could be seeing the indicators signaling the start of a new downtrend. The other concern that I've had, it's more fundamental. I know I'm supposed to be a technician, but what I really thought was going to happen was we were going to see much better earnings this quarter than anyone expected, and that was going to cause some confidence in the general market, and the market would broaden out. You know, obviously the good earnings were concentrated in tech, which was the most overowned sector, but still that should have been inspiring confidence. Instead, what the market may be saying, and again, it's a little early to say this for sure, but we have to watch for it, is that these earnings may be the best earnings we're going to see for a while. In other words, the stocks sell off on these really good earnings. That could be a sign that the market is thinking that earnings are going to get worse for the next couple of quarters, the economy is going to slow, and we're going to see some more layoffs and stuff without a lot of hiring into next year, in which case we're going to see a tough fall. And so I guess what I'm saying is I'm going to be a little bit more cautious here in terms of the technicals, see how we do, but I'm advocating covered call writing now and certainly keeping risk on a very short leash. If you're trading, try not to lose a lot of money here. This is a very tough trading environment all of a sudden, and honestly, I wish I had some idea what this thing was going to do after this debt ceiling business is over. I don't. I do think that what everyone thinks it's going to do is probably not going to happen, which is a rally. And as I'm concerned, we have more decline after this debt ceiling business is over. We'll just have to see. Let's talk about the bond market for a minute. Obviously, interest rates are part and parcel of this whole deal, and I have no change in any of my opinions on interest rates. Looking at the LQD, looking at corporate bonds and municipals, those seem to me to be a better bet. The charts on those are much, much better than anything in the Treasury area. So I would be focusing my efforts on those. And in last week's report, we published something on, some very short-term ETFs. Those actually look decent, and maybe some of the international ones. What looks really interesting here, and what we should talk about in some depth, is gold and silver. I'm going to again point out gold and silver should continue to lead this market for two reasons. First of all, I believe we are seeing cost-push inflation. Gold and silver do well in inflationary times. Obviously, there's some uncertainty here as well. Gold and silver have a tendency to do well in uncertainty. And so I guess what I'm saying is the commodity area remains a favorite area for us. We've had some good discussion with people on the relative merits of gold versus silver. Silver, to me, may be a better trader, but again, if you are looking at an investment, gold is a better investment. Gold, for example, well, let's just take a look at it this way. If you bought silver when it broke out to new highs at 48 back before the markets came down, it's at 38, down roughly $10. If you bought for your clients the GLD on the breakout to 152, currently you're at 156. So you're actually, if you bought that breakout in spite of the decline in the metals, which is really quite sharp and precipitous, you're actually profitable on gold, which as an investor is someone you're going to buy and hold. So we would be looking at gold more as an investment and frankly more as a trade. And again, IAU, we've talked about this a couple of times, it is 10% of the GLD, so it's actually even less than the SLV to trade. That's probably where I would be putting some investment capital. We also think that oil is going to do well going into the end of the year, and we would be using dips on oil to buy oil in ETFs that are related to oil. The most common one is USO. That is front contract loaded. There's a couple that are worth looking at that are not front contract loaded. The first one is DBO, which is PowerShares Oil Fund. They use a 12-month average of the contracts to set their value. That may very well be a better investment. And USL is another 12-month oil fund put out by the people that do USO. That also may be a better investment. I would certainly add a couple of those as well as just a straight position in oil if you can do that. The other thing that is looking much better actually than oil is UHN, which is heating oil. So I would add that into the mix. Especially as heating oil has a tendency to do well into the end of the year when it's cold, which I know is probably a dumb observation, but you know, heating oil looks better, and I would use any weakness in here as a stock buyer to add to the XLE, which is, I think, still are going to stay our best overweight for a while. We like it as an investor. As a trader, we may see some funky things. The earnings today on Exxon, for example, were very good earnings, but under forecast. So you're going to see some stuff. And Exxon, by the way, is another example of what we're talking about. The stock got oversold. It made new lows in June versus May. The stochastic got overbought. We were having a nice run, but it has made lower highs with the stochastic overbought and having gone below 80 than it did at the last peak in April. So that may actually be starting to signal a little bit of a downtrend in these stocks. Now, again, if the market gets punk here, if we start to see some real sloppiness going into the fall, everything is going to have some trouble. But we still like the looks of these oils on balance better than a lot of other stuff. With that, we're going to get into some of the stocks. We had a bunch of stocks emailed in.